Okay, everyone, good afternoon and welcome to our fixed income webinar for March 2021. Hope you're both well. As always, my name is Jonathan Wu, Chief Investment Specialist at Premium China Funds Management. So let's jump straight into it. Standard disclaimer, everything I say today is obviously not in advice. And then firstly, straight off, we are running our first live roadshow back for 2021. We'll just be running it in Sydney, solely because of the fact that we don't know what other restrictions could come into place as the months roll on. We've seen other states do snap lockdowns, and that could impact obviously our venues and disappoint people in somewhat. So we've decided to just run it in Sydney. We will be live beaming in Renee Hung, our PM of the Prim China and Prim Asia funds, as well as Gordon Ip, who is the PM of our Prim Asia Income Fund. And we'll be doing a live stream to all other registrants, and we will be applying for CPD points. For those of you that are in Sydney, most likely the venue will be the establishment on George Street, which is a great venue we've used for the last 5 or 6 years and can accommodate 140 advisors that we usually get. So just a bit of housekeeping, just to remind everyone, these are the platforms that we are available on as at today. Just take note of BT Panorama. If you're part of the transition, if you currently already hold units in the Prim Asia Fund, they will do an automatic transition, but you can't add new units to it. Please speak to your BDMs and request for the fund to be added on, and then that will obviously help our cause and obviously allow your clients to continue to be able to invest in what we think is a fantastic unconstrained bond strategy in an environment with very low yields. So in terms of how we see the world, things haven't changed too much. We do have a new risk, which was the reflation trade, or is the reflation trade, depending on whether or not you believe that this trade is over in the short, sharp 6 weeks that it started in February. And I'll talk about that from a fixed income perspective in a minute. Just to remind everyone, obviously our fund manager is Value Partners based in Hong Kong originally, and they have about $14 billion funds under management, with 10 of which is equities and 4 billion fixed income, making us the largest Asian high yield manager in the world. We've got 70 investment professionals looking after your clients' money, and we have global presence because we now also have a London office, as well as all offices across Asia, to give you the best of breed investment ideas. We have a close-knit investment team. For the purpose of today's webinar, I'm focusing on the bottom part here with Gordon, Elaine, and Edwin. Elaine is the 2IC on this strategy. She focuses a lot on Chinese property bonds, and Gordon is the CIO, who will be speaking live to us on the 1st of June roadshow. Our investment philosophy is very simple. We see ourselves as a quality value manager. We don't buy stocks just because they are cheap. We call that the value trap. But we buy stocks where we believe they're trading under their intrinsic value, which is the most key important metric for us. We do over 6,500 company visits a year, and that's something that obviously we pride ourselves in achieving for clients year in, year out, to find the best of breed ideas in both fixed income and equities. And last year we blew all records and did 8,600 company visits, excluding AGMs and broker-led meetings. So let's jump straight into Asian credit. This is an update to our team. What is very unique in our team that's different to almost all other bond managers in the world is that we have a lawyer that helps us pick credit. So you see here, Alvin is a critical element of our investment team, because when we do bottom-up research on debt, one of the most key important things is that we do not care at all what S&P or Moody's or Fitch say about a particular bond, of which most of the market in reality is unrated bonds. And always remember that an unrated bond doesn't mean it's a bad bond. It just means simply that it's unrated. You get a rating for a bond because you feel that you need it to sell. And in Asia, that's simply not the case. So therefore, it really relies on the ability for the manager to do on-the-ground research and to generate those on-the-ground ideas, which is what we've done for the last 10 years and achieved a very, very good outcome for investors. Very, very proud of our track record there. So we run it's a multi-strategy fixed income fund, predominantly targeting high yield investments. We do some primary issuance like we did, I think I shared last month with regards to the Israeli government bond trade, which was effectively a no risk trade to make 7% in a week. We have had some investment grade in the portfolio. That was especially the case post-COVID because it gave us the opportunity for the first time in 10 years to be able to buy investment grade debt at high yield prices due to the total lack of liquidity that was sucked down the market in March 2020. And then we have special event and special event driven opportunities in the portfolio, which at the moment we actually have none, which is fine. That makes up how we run the portfolio. And then overlaying that, Gordon then runs an active currency hedge, effectively utilizing the fact that the AUD-USD relationship is a risk-on event. And so when China's doing well, there's no political unrest across the world. Usually the Australian dollar goes up, commodity prices are good. And so when the world's healthy, Aussie dollar generally rallies in that environment. When we have things like COVID, if you remember last year, the Aussie dollar fell from 70 odd cents down to 55 in a short, sharp couple of weeks. So Gordon actually utilizes this to reduce the overall volatility on the fund. For those of you that are already invested, you would have noted our outstanding performance in March 2020 in that month of illiquidity. On a mark-to-market basis, high yield funds were falling somewhere between 15 and 20%. We fell 7.3%, outperforming a lot of our investment grade peers. And the key reason behind that is because of the fact that Gordon effectively took off all hedging at around 70 cents and rode it all the way down to 55, effectively masking the issues that we've had with regards to illiquidity on the mark-to-market basis. And then on the back of that, when the Aussie dollar went up to about 58 cents, he re-hedged it, and now we're at about 96% hedge and holding steady because we believe the Australian dollar still has a way to go due to the long-term debasing of the US dollar. And that's something for everyone to consider. One of the key strengths of our strategy as well is noting that that there is a lot of interest in China bonds and investing into Chinese bonds to get a yield. Just to give you a contextual yield point, a 10-year Chinese government bond pays around 3% a year, which out of all developed nations, China pays the highest level of yield. So that's something interesting to note, which is why the opportunities that we then present to you are also equally as attractive. So we're screening the market overall to find investments that are paying at least 6% cash yield. And then we then screen that down into an active monitoring of somewhere between 800 to 1,000 bonds, and then doing bottom-up credit research to then come up with our screen list of about 300 to 400 bonds to build a portfolio. So generally over the history of the fund, our portfolio is held somewhere between 60 to 70 bonds. At any 50 to 70 bonds at any given time, and we do spread the risk quite heavily. So unlike our equity funds where we can go up to 10% or more in the single company, we can't hold more than about 5% in a single bond issuance. So that's very, very important. And then furthermore, because we don't take local currency risk, which we think is a very high risk, there are a number of products coming to market at the moment where they buy local currency risk because they believe that if a country or a company goes bankrupt, or more specifically a sovereign debt goes bankrupt, the country can print its own currency to pay back capital. But you just imagine that translated back into your local currency, that currency is not going to be worth the paper that's written on anyway. So you're dealing with multi-currency, you have to deal with multi-hedging strategies, and those in a fixed income portfolio we believe is highly risky, something that we will not attempt to do, except maybe with the exception of onshore China bonds, because there is such a heightened demand for RMB denominated assets, in which, because China is a developed economy, RMB as a currency is very, very stable and controlled very heavily and very rightly so by the Chinese central government. We do stress test the portfolio every month, and that's critical to our liquidity testing. And we can actually liquefy 100% of the portfolio in a single day. The fund strategy is about $62 million. We've been added to a number of models in the last couple of months, building that fund up quite heavily. It was sort of $40 million only a couple of months ago. So thank you for the guys that have just added to your models to diversify against all other forms of bond risk in your portfolios. I'll skip over this chart because this just focuses on what our bottom-up credit analysis does on a day-to-day basis. But in terms of our credit risk scorecard, depending on what we're trying to achieve with our underlying strategy, we are either buying this bond because of capital appreciation, because we're trying to get income out of it, or we're doing a tactical trade, which is usually very short-term in nature. So as you can see, if we do something like a tactical trade, the liquidity weight in terms of our scorecard is critical, because we have to ensure that we can get in and out of the position very, very quickly. So we don't invest in anything less than 4 out of 5. And a lot of this data is all dragged in through Bloomberg to effectively give us a much more quicker way to get an overall look at the company before we begin the bottom-up fundamental analysis, which is ultimately the critical point. So talking about the reflation risk from a fixed income perspective, so obviously we saw a huge and sudden change in market sentiment driven by inflation expectations. So we saw a much steepening of the yield curve. We then saw central banks effectively come in and buying, whether it be in Australia and the US, buy bonds off the market to effectively push down the yield. This effectively signals to the market that, and on top of the actual physical signaling after each of month's RBA and also Fed's meetings, they do not want to increase rates for many, many years to come. And in actual fact, if you consider our own house view, central bankers in this generation are very, very wary of what will happen in a world of $300 trillion worth of debt. What that is going to look like if they raise interest rates. You consider $300 trillion worth of debt globally. You consider a 1% increase in interest rate. That means that's $1 trillion of interest. The whole world's global GDP is $72 trillion. So you're allocating more than 1%, about 1.5%, just to pay the interest on that debt. And you consider that just before the GFC, we were at about $100 trillion worth of debt. And we were supposed to reset the cycle, start again, and we jumped to 300 trillion now. Now, the question then is inflation in of itself bad for the credit market? Well, ultimately, it will depend on what type of credit that you hold and what type of spread that you're holding it at. So our portfolio is made up of all fixed rate bonds. Under a normal environment where rates will go up, that is not great for us. But there's 2 factors to remember. If you have a portfolio of bonds where the spreads are very, very tight, each upward movement in the underlying risk-free rate will have a gigantic issue for your portfolio's capital value. But if your spreads in our case are over 400 basis points, the risks obviously are a lot less, and obviously you also have to assume that the rates are going to go up in a short, sharp way, which we don't think is going to occur. And given the fragility of the global economic recovery as it stands now, even with global vaccination, we are some way off from getting to a point where central banks will be willing and comfortable to see interest rates go up. The other thing to note as well is that central bankers, as part of their sort of strategy of being shy to increase interest rates, is to also consider the definition of inflation. So core inflation, long-term average core inflation in the United States, the target set by the chairman is 200 basis points. The fact of the matter is if you actually look back over history, all the way back to about 25 years ago, and actually map out the definition of long-term core inflation in the United States, only 20% of that time did we actually see inflation achieve 2% or above. So therefore, they're effectively taking a very, very conservative approach to try their best not to increase rates, let alone on their term of being governor. So I've had this chart now updated to the end of February, and we're now sitting in a position where we have less than 5% of the world's bonds are paying more than 4%. Okay, and if you then take into account any bond that pays more than 5%, you're talking about less than 2.5% of the world is actually paying that. So this whole issue around negative yields is here to stay. And this whole argument that we have around what we call justifiable yields is also critical to the way that you construct a client's portfolio going forward. Because the fact of the matter is that if you critically understand the fact that we are at the end of a 40-year bull market on bonds, then you also fundamentally realize that even if we stay in this low rate environment, traditional bonds cannot generate a justifiable return for you, let alone when the curve actually physically steepens and we actually see real rates go up, what is that going to do to bonds overall? So it's something to be very, very critical of, even if your argument is stating that bonds have a negative correlation to equities. So then people are asking, should we be buying bonds now? Well, it depends. I've sort of held this viewpoint for a very, very long time, but I didn't want to share it because some people that I've shared it with have basically tried to hit me on the head with it and said, please don't tell anyone about it. And I sit here and go, well, as a fund manager, whether or not you consider me a marketer or not, it is critical for me to tell the truth around how bonds are being used. And as we travel around the country, what we can see here is that when we look at platform flow reports, we still see record levels of money going to Australian international government bond index funds. And this is what you are telling your clients. If you are doing this, you're saying that we are here to generate for you this cash yield. In Australian bonds, you talk about 2.89%, in international bonds, 1.47. But then that's all that's being told to the clients. The client go, oh, that's all right. That's better than term deposit, where I'm only getting 0.4 or maybe 0.45 at the moment. But then on the other side of the flip side, are advisors, researchers, and consultants telling their underlying investors that every year you will register a capital loss by holding these bonds? And in actual fact, if you consider what happened in February, that's the first taste for anyone that is in traditional bonds would have realized that that was a horrific outcome. Okay, we had no impact to our portfolio. In fact, we were up 62 basis points for the month of February. So the reflation trade had very little to do with us because we're writing fixed rate bonds with a very high spread, non-correlated traditional bonds, let alone equities. So what you see here is that you need to be very honest with the client and tell them that while you're getting a cash yield, every year you're going to lose that amount of money. Okay, and effectively, you then have to follow up and conclude with your client and tell them, if you're buying Australian government bonds, I'm asking you, Mr. and Mrs. Smith, to pay $111 for an asset in which in 6.7 years' time, I'll guarantee you I'll give you back $100. But in the meantime, you'll get 2.89%. So when you actually factor in the capital loss that you're basically guaranteeing for a client, your yield to maturity becomes a lot less attractive than the cash yield. Okay. This is our month-end data for our fund. We are generating a cash yield of 7.32 with a yield to maturity of 8. So what we're saying is that over the next 2.9 years, every year you'll pick up 7.32% in yield and 75 basis points in capital gain. And on average, we're buying bonds as a value manager at less than $100 in value. To give you an idea of how bad this was in March or in April, after we started moving our positions last year, post the COVID illiquidity crash, our yield to maturity was about 15%. So when we then averaged that back, this was trading at closer to sort of $90, about $85 a bond. That's how bad the situation was, perceived at least from a liquidity perspective. So when you consider bond strategies going forward, I'm just using indexes so I don't get trouble on, note what you are actually communicating to your clients is absolutely critical going forward. Then we need to consider also the correlation benefits of Asian high yield, and we buy US Asian high yield. Now, traditionally, this is a chart that's showing the correlation to equities. So the further right you are, you have a strong correlation to equities, and the more up you are is the higher the underlying yield of the underlying sector that you're buying into. So what you see here is that this is traditionally where people have gone when they said we want to get some access to high yield, we want credit, we think that that part of the market is more attractive in a lower rate environment. So great, you are now pushing your clients reasonably close to somewhere between 0.8 to 0.9 in terms of correlation to equities while generating high yield of around 5% for US as well as 3% for Europe. Then you've got Asian high yield in USD form, and that's what we invested. Okay, so we're looking at 7% with a 0.7 correlation to equities. So this provides a great correlation or anti-correlation against equities by being invested through our strategy. Now, obviously, most of you that have followed the strategy for a number of years notes that we have a reasonable chunk of the portfolio in Chinese property developers. That's actually dropped to 7% over the last month, and I'm going to explain as to why. That's not our reduced amount of conviction. That's solely because there is a change in the structure of the market in which we have raised cash to around 14% of the strategy, up from 7% in the previous month, but I'll talk about that a bit later. But the China property market continues to go from strength to strength overall. Now, what I'm talking about here is looking purely on the fact of contracted sales and comparing for the last 3 calendar years, so 18, 19, and 20. And you can see here that post-March, the trajectory has just remained northbound and very, very strongly so. And then one of the other things that has been a key concern for investors longer term has been this issue around the level of inventory that's being held in Chinese cities. So you've got tier 1, tier 2, and anyone below that. You can see that from during the COVID crisis, it was significantly higher, but then that also dropped off quite significantly post that. And you can see that riding out to around the long-term average of around somewhere between 10 to 12 months of inventory. So what that reflects is that it effectively takes 10 to 12 months from the current level of stock to clear through based on the current trajectory of sales, based on the last month's sales figures, and that's sharply come down. So that's a good thing. That means the developers are turning over developments. That means they're searching for new land and then going to build the next apartment building, industrial complex, or commercial tower. Now, one of the things that, and this is going to be an entree really into next month's webinar, in actual fact, is that the Chinese government has now moved into the space of effectively trying to contain credit growth and try to effectively prevent another credit bubble from occurring. The last one they managed to clear through since 2017 without too many issues, and the overall economy, or the heat that's been generated by the level of leverage, has slowly come off over the last couple of years. Then you had COVID, and COVID then obviously brought about this fact that governments were then scrambling to consider how do we stimulate the economy. But what the Chinese government had learned from 2008 and 2009 is that when you try to encourage people to spend and encourage people to consume through different various stimulus programs, you also then create the threat of inflation. You then create the threat of increasing amounts of credit that's not flowing to the real economy, so on and so forth. So China's created a new standard called the triple three red line rule, and which I'll go into next month. But as part of that, one of the new rules that were implemented for property developers is that they could only refinance existing debt. Okay. And in actual fact, not only that, but they can't actually go out to the market to issue more than 85% of their current debt book. So if they have $100 million outstanding in corporate bonds issued to the market, they can't go and issue in this year more than $85 million of new debt. Okay, effectively, you're stopping developers from basically extending themselves too much by either overbidding for land, okay, because the prices are going up, or you're basically trying to rein in their level of expansion to effectively ensure that if there was any correction territorial risks that's coming through the market, that people don't fall, that developers don't fall over and are unable to then refinance if we have another sort of liquidity risk come through the system. So what you can see here is that if we just focus on 2020 or even 2019, you can see that the net supply of new bonds was quite high. Okay, so 64 million in issuance and $12 million in redemption or maturing bonds, okay, in that calendar year. In 2020, that fell. In 2021, based on our expected implementation of the rules, you can see that we're only going to get to a net supply of $4.2 billion US of new debt, which means that because of the fact that there's more demand than there is supply, and previously in previous years you could get access to ample supply, that means good debt will go up more in value. And that's something that will be positive for our portfolio because we currently have about 37% allocation to the property market. So as you can see here, this is the last month's performance charts. We achieved a 62 basis point net of fee return for investors. That's on the back of the fact that there was the reflation trade, risk of steepening yield curves, and effectively traditional fixed income funds just did not hold up well at all and actually went backwards, leading to many advisors questioning what happened. So over the last 1 year, we've still registered inclusive of the COVID correction. We've done 7.5% net. We paid our distribution of 1.5% in December. We are due to pay another distribution at the end of this month in a couple of days. So watch out for that. I just do want to point out something that sometimes happens to a number of our advisors over the course of certain periods when they look to redeem or rebalance client portfolios out of the pre-major income fund. One of those key points is that when we get to an end of a quarter, and this is purely a housekeeping issue, it's not an investment issue, is that just like at financial year end with equity funds, all funds get frozen. Their unit prices get frozen. Okay, so to be very, very clear, I know everyone, for those of you that have lived through the GFC like myself and looked at funds freeze, that word is very, very scary. But what I'm focusing on here is that the unit price of a fund is frozen until the time that the distribution is declared and then catch-up pricing starts. So in practical terms, if you put in a redemption order at the beginning of any quarter, right? So say, for example, even if you put it in on the 5th of April, this coming in a couple of days' time, usually you get your money back under a normal circumstance when there's no distribution going on in the background or distribution pricing going on in the background. You'll generally get that back in about 5 to 6% days. Under a distribution end of quarter, you won't get your money back till around the 20-something of the month. Now, you'll still get priced up as the 5th of April in your redemption, right? So you're not taking any market risk. But because the catch-up pricing hasn't occurred, you won't actually settle that trade for your investor till sort of closer to the end of the following month, post the end of the last quarter. So please take that note into account. We can't speed things up. And I do understand that when you rebalance client portfolios like we do as part of our advice business, it can be frustrating that you're waiting and waiting and waiting for the funds and they still haven't arrived. Don't worry, they are to come. But if you're looking to redeem, it is best to redeem at the end of a quarter without having to risk at the beginning of the quarter when you rebalance client portfolios. So it's just something to take into account there from a pure housekeeping perspective. So our cash yield, as you can see here, ending February, 7.6% with the yield to maturity at 8.17, and our time to maturity is actually a bit shortened now, even to about 2.5 years. And we're very proud of the fact that not only that we've had a very, very strong return since the inception of the strategy, which will turn 10 years old in a few months' time, but we've done it with volatility of only about 500 basis points, where our target volatility is actually somewhere between 6 to 7%. But because of that active currency overlay, Gord has managed to basically flush some of the and offset some of the volatility of the underlying market for the benefit of you, our clients. In terms of the allocation, the previous one was just a map. This is just represented now in bar charts. The change is that we've now raised cash by 7% to look for new opportunities and repositioned effectively 7% out of the real estate sector into cash. And because some of those bonds have matured, and this was the market structure change that I was talking about, we're still very, very positive as per my previous slides on the property market overall. But what is critical to note here is that in terms of the real estate portion of it, if we can't get into some new issuance, for example, we have ended up to raise cash to look for other opportunities in other spaces. But as the fund keeps growing at the rate that's been growing very, very strongly, because we're writing hundreds of $1,000s a day at the moment into the strategy, is that the portfolio will get even more diversified from the perspective of where we sit even within the real estate space, because of the fact that the bond market overall is growing exceptionally strongly. That's a taste of our distribution chart for the last couple of financial years. So we now have 38 observable periods on the strategy paying distribution. There has not been a single distribution since the inception of the fund that's been less than 1.5%. So we are here very confidently here to tell you that we're trying to achieve a 6% cash distribution in your client's hands every year. And if at the end of the financial year we have something extra to push out as a bullet, we will do so. And so investors have been very, very happy with that very steady cash flow they've been getting out of the strategy since inception, which is fantastic to see. And in actual fact, our family topped up our investment from $4 million to $5 million about 6 months ago, as we had some term deposits roll out, just to reflect our high conviction in this strategy. This is the updated risk return chart for the last 10 years. And I was sort of presenting this chart to an advisor, which very smartly pointed out the simple fact that, hey, Jonathan, this chart goes all the way back to 2011, where risk-free rates were far higher than where they are today. So if you're generating a total return of 4%, something to 4 or 5% for the last 10 years, that's not all income. That's capital gains and income. So if we now are at 0 rates and there's no opportunity to make a capital gain in traditional bond funds, well, and there's no yield, where will these dots keep moving towards as we continue on a 0 rate world? This is an update to our best and worst time periods. So best, I'm just going to ignore that. Worst time period is still COVID, and the worst 3 years was the point leading up to and including the month of March 2020 for COVID, where our annualized return dropped to 420 basis points per annum net of fees for our clients. So this is not a fund that you buy into for a year. It's not a fund, but on a 3-year basis plus, if that is your investment time frame, the worst that this fund has ever generated was 4.2%. And this is at the back end in a market where the rates have continued to fall. And updating our quartile performance chart against index, which is the red dot, versus us, which is the blue dot, over year to date 1, 3, 5 years. The next slide is 10, so we're just short of a 10-year track record. We have always been first quartile under all time frames, and sometimes the #1 fund where we actually breach the top quartile line there, as you can see, on a 5-year basis. And our drawdown, our upside and downside capture updated to the end of February. Our upside capture against the index, we beat the index more than 80% of the time when the market goes up, and we underperform the index on the way down around 30% of the time. Okay, so this is one of the best ways for us to sort of express to you how we run this strategy to basically protect your investors as best as we can. So that's the end of this month's webinar here. I see there's no questions in the box. Please reach out to myself or Derek if you have any questions. It is SQM researched at 4.5 stars, which is outstanding. And that is the highest rated global bond fund by SQM. We are getting the fund rated by Longset later on this year, so hopefully we'll have some good news to share with you there. But stay tuned. As I said, 1st of June, mark that date, especially if you're in Sydney. Please join us at our live roadshow. Otherwise, I'll catch you guys again next month. Stay safe and have a great month. Thank you.